Given their new environment, many bulbs succumbed to a disease, a color-breaking virus that is transferred by feeding insects. It causes the petal pigmentation to break into flame-like multicolored stripes. The Dutch prized these patterns. Since tulip bulbs are perennials, the bulbs preserved their uniqueness and perceived value due to a scarcity of the patterns that were the most prized. As with any rare product of fixed supply, increased demand caused a rise in the market price. Bulb merchants stockpiled the most popular patterns and held them back from the market artificially.
In effect, the phenomenon of tulip mania resulted from hoarding, which led to an escalation in prices. To invest in bulbs, Dutch citizens liquidated good stores of value. Purchasing frenzy caused bulb prices to reach astronomical levels. As market demand outran investment capital, speculators developed call options. These required only a down payment of the purchase price. In January of 1637, margin buying spurred bulb prices to rise 20-fold. However, the bubble burst. During the following month, prices plummeted 20-fold. As the market tumbled, the market equity positions of investors evaporated. Panic ensued. Investment funds fell into bankruptcy as they failed to honor their call options.
Faced with a collapsing financial market, the Dutch government intervened and attempted to settle contracts at 10% of their purchase price. Unfortunately, market prices continued to fall, dropping below the government price floor until tulip bulb prices settled to that of a common onion. The tulip bulb craze mimicked the behavior of other bubbles that have occurred to the present day. First, market speculation built slowly with a gradual ascent in prices. Second, the number of investors increased and that fueled progressive speculation. Third, speculators introduced margin buying, and that helped the market to grow exponentially. Fourth, as the bubble developed, the market rose rapidly to spiked prices. And fifth, that bubble burst and market prices collapsed rapidly due to a contemporaneous failure to meet margin calls.
Next, we will look at the British crisis known as the South Seas Bubble, a crisis that stands as the first major manipulation of financial markets. Until the crash of 1929, this bubble endured as the classic example of opportunistic self-enhancement.
The South Seas Company was formed by Parliament as a British trade concession in 1711. This was a monopoly for areas of the Pacific that were under British rule. The company was a startup firm with no sales and no earnings, only with great prospects. The real prospects centered on market manipulation and insider trading.
In the early 18th century, Britain had entered its period of imperial prosperity. However, stock ownership remained a matter of privilege that was limited mostly to the aristocracy. Furthermore, women could not inherit land, although females could own stock at that time. A pent-up demand for stock developed because of wide accessibility, along with the added benefit that dividends that were paid out of profits went untaxed. Parliament granted the enterprise a monopoly concession along with loaned capitalization of £10 million sterling.
Publicly unknown at the time, members of Parliament had bought the capitalization bonds for South Seas at £55. Once the company went public, these investors exchanged each unit for £100 of stock in the South Seas Company.
However, its inexperienced directors quickly entered into the slave trade, a venture at which they failed. South Seas maintained its stock price in the market despite this misfortune, as well as a war with Spain, shipments of goods that were misrouted and lost, and bonuses paid to the directors in the form that diluted the value of shares.
Nevertheless, the situation improved in 1719. Britain signed the Peace of Utrecht, a treaty with Spain that enabled British trade with Mexico. Given this newfound prosperity, the directors of South Seas offered to fund the entire British national debt of £31 million. Stock prices doubled.
5 days after the bill became law, South Seas offered a new issue of stock at £300 per share. The company offered a second issue at £400. This one rose to £550 per share within a month. The directors offered yet another at 10% down, with no payments for 1 year. Share price continued to rise to £1,000. The feasibility of the scheme became secondary as the greater fool theory took over. Speculators would purchase shares, prices would rise, secondary buyers would appear, and the speculators would profit in the aftermarket. The summer of 1720, the directors liquidated their own shares. The news of their divestiture leaked out quickly. Share price collapsed, and a market panic ensued. The British government narrowly averted the complete erosion of public credit. In response to this threat, Parliament passed the Bubble Act that forbade issuance of stock certificates in any company. In addition, Britain implemented other measures in order to restore confidence. The government confiscated the estates of company directors in an attempt to remunerate South Sea company investors. Other propositions put forth in Parliament included placing bankers in sacks filled with snakes and throwing them into the Thames River.
In summarizing this bubble, let's analyze the events. First, there was a pent-up demand for investment opportunities. Second, the government sponsored a trade concession monopoly. Third, inexperienced management failed to create any real value for the company. Fourth, war and the entry of new competition exerted external pressures on the firm. Fifth, graft occurred, which involved members of Parliament in an effort to pass legislation that was advantageous to a private company. Sixth, dilutive stock dividends and new dilutive stock issues were sold on generous terms and margins, while insiders manipulated trading that included the dumping of shares.
Following the Wall Street crash of 1929, the United States and its major trading partners experienced a decade of severe economic downturn that led to the Second World War. Though production surged during the war, a full recovery of the stock market was prolonged. While it took Wall Street over 20 years to regain its level of 1929, it is unfair to look at the Great Crash as any single event.
Following World War II, Wall Street held a widespread belief that these institutions had risen above the madness of the crowd. However, professional investors participated in several speculative movements from the 1960s through the 1990s.
The soaring 60s marked a return to the former depths of market depravity. From 1959 to 1962, the market saw more new issues than in any previous period.